Good afternoon, everybody. Following the footprints of the previous presentation, I'm very, very pleased to introduce three fantastic speakers today, all coming from different industries and different experiences over here on how they touch the venture capital world, their exposure to it, to really give, I guess, much more experienced and different perspectives over here on how they, as investors, approach some of these early stage investments. The first speaker that we have today is coming from KPMG, is going to be speaking today. The topic of the first presentation now is the essentials of the asset class, why this asset is different from all other assets, why venture capital is different from real estate, bonds, and all other types of potential investment opportunities that exist out there. Amir Shani is a partner at KPMG, advised in the advisory forum, has done extensive M&A buy side and sell side, and has worked with many of the leading VCs and PEs, private equity firms in Israel, who will be sharing his thoughts on, again, why this asset is different from all other assets. Thank you.
Okay. Hi, everyone. So, as Shmuel mentioned, I'm coming from KPMG. As you can imagine, I'm an accountant. But what I'm doing on a daily basis is work with people, I think, in a very similar profile to the people that are sitting in this room. It can be entrepreneurs, it can be VC investors, PE houses, family offices that invest in tech companies, and I'm trying to work with them and understand what is the unit economics and what is the business model behind the company, okay? And what I will try to do in the next 10 minutes is to give you some basic tools how to analyze a business. I'm not going to speak about evaluation, which I know is critical and very a curious topic, but I will give you tools to think on a business of a company and evaluate it. And I want to start with an example, which I'm sure you are all familiar with. The electric scooter company, Bird. We see them every day in Tel Aviv, in Jerusalem. I personally, when I see these scooters, I see unicorns. You know why? I don't know if you know, but Bird owns a very lucrative title. It's the company that became unicorn the fastest. The company was established by around the end of 2017, and in mid-2018, they raised $200 million in a valuation of $1 billion. Today, by the way, the company, we are 2.5 years later, is around $2.5 billion. And let's try to ask ourselves why. So I don't have any formal financial information about Bird, so I used a very interesting research paper that McKinsey published. And I want to show you two aspects from this paper. One, the market. Bird is aiming to a very significant market that today we don't have really good solution, okay? We all can agree that the market, by the way, is obviously micro-mobility. You can see the estimation, $200, $300 billion market in the next few years. It's a huge market. Without good solution, we all can agree, I think, that Bird, they don't have a deep technology, right? But still, they are targeting a very large market, and you can ask if they will only manufacture the scooters. Will they be at the same valuation? Probably not. Why? The business model. And here McKinsey has done an analysis and tried to understand, not specifically on Bird, by the way, but on the industry. You can find the research. And they are showing how profitable, or if to be more accurate, cash generating this business is. And this is the key. They are showing what is the average revenue per scooter, the capex required per scooter, the operational costs, and show that, guys, this business is generating cash. And I want to quote Bird CEO, I found an article that was published recently under the title, Bubble or Boom. 2-year-old scooter startup Bird is now worth $2.5 billion. And the CEO said the following: nearly a year ago, we recognized that the world was changing. Gone are the days when top-line growth was the leading KPI for emerging startups. Positive unit economics is the new goal line. He's saying, guys, we have a business model that generates cash. And this is why we work so much. And again, I'm not familiar, the real numbers are not public, but I think it's a very interesting example of a creative business model. Now, let's move forward, and I think we can do this session without talking about software companies, which are, I would guess, a significant portion of the portfolio of most of the investors in the room. And when we are speaking about a software company, usually we are referring to SaaS companies, software as a service, as you all know. So what is SaaS? So basically, SaaS is a technology revolution that happened not that long ago, and suddenly we can access to a remote server, get data, activate software, and so on. There are great advantages on the technology side for SaaS platforms, but very clever people identify that there is a huge economic potential to this model, and there are great advantages. By the way, one of the first pure SaaS softwares companies is Salesforce, which today worth around 160 billion. It's one of the first one, but along the years, many traditional software companies like Microsoft shifted in many of their products towards SaaS model. And why? I will refer to 2 points, and I will use as an example 2 very interesting and familiar Israeli companies. And the first one is Monday.com, and I look at their website and I find their pricing model. And look how it works. They have a package that depends on the type of the client and the features he needs. A basic client, a small company that wants to use their product, will pay probably $39 per month. If they want more advanced feature, $49, affordable. By the way, you can see on the top line that as the organization is growing, the price per seat is usually lower, but the total contract value is much higher. So think about the sales cycle for this type of a company. It's very easy. We are selling a very cheap product. We can approach large enterprises. We can approach small organizations. But after we've completed the first sale, now we can grow the account. Usually in SaaS companies, the sales organization include 2 types of salespeople. Hunters, the one that acquire the client for the first time, and then the farmers, the ones that are growing with the client, changing the usage from basic model to professional, and then sell more and more features and do the upselling on one hand, and on the other hand, along the way, they are growing and more people within the organization starting to use the solution. So this is the first parameter for a SaaS company. Let's speak about the second one, and for this I used an example from Week's last investor presentation, and let's see what they are showing us. And this is part of the magic of SaaS companies. What they are saying look, in 2010 we got few millions of dollars from customers. In 2011, the same 2010 customers, we continue to generate revenue from them, but we also, again, hunters, we brought in new customers. So this graph is called cohort analysis, and basically, let's go to the end, we can see that in 2018, from the existing clients we had in 2017, we grow all those accounts, and we earned more $50 million. And still, we are obviously continue to bring in more and more customers. So maybe you heard the term stickiness of a product, but this is, again, part of the magic. We enter an organization, provide a good solution, a solution that it's very hard to replace, and along the years, growing and growing the business. And I want to move forward to the last example. And I know it's very quick. It's a company in a case that I personally really like, and it's, by the way, a portfolio company of OurCrowd. I'm quite sure you all heard about Beyond Meat. I was personally assist one of my clients a year ago, less than a year ago, during the IPO of Beyond Meat. And I want to show you the following. This is the profit and loss statement of Beyond Meat from the prospectus. That was published just before the IPO. It's hard to see, but generally, in 2016, the sales was $16 million. The gross margin, the direct revenue per hamburger that we sold was negative. You can see we lost $6 million on gross margin. It means that we sell each hamburger in loss because we want to win market share. And obviously, the bottom line is a loss. In 2017, you see the revenue doubled to 32. In 2018, just before the IPO, around $90 million in revenue. So extremely high growth company. But in 2018, this company still lost $30 million. And now the question is, what is the value of a company that is still losing $30 million? Someone can guess in what was the valuation prior to the IPO? Guess? So it was $1.2 billion. A few days before the IPO, the demand was so high that they even raised the value to 1.5. And again, it's a losing company. And the question is why? And again, back to the business model. We are disrupting a huge market of trillions of dollars with a good product, growing very fast, selling to leading restaurants. So the market and the investors believe in this company. By the way, a week after the IPO, the value was approximately 4 or 5 billion. Few months later, it reached above 15 billion. And today, it's around 7. So you can see the roller coaster in the share. It's quite amazing. By the way, in the last financial, the growth is continue to be amazing. Today, it's almost $200 million in revenue. And for the first time in the last quarter, the bottom line is positive, which is, again, a very good and interesting indication. I would like to try to summarize, and I hope you got some ideas from the example that I brought in. First of all, remember, it's still a risky business. Although we are speaking about new business model, we must make sure that the business model, first of all, has good, reasonable unit economics, that the business is profitable. You heard the statement of Bird CEO. And remember that although the business model is good, there are still risks. Again, I didn't include the common examples of WeWork and Uber and all these disruptive companies, but the unit economics is critical. Another point, which is very significant, is the market. Okay, I gave you a few examples for companies that are aiming to huge markets and disrupting these markets. And this is also a very significant part of the valuation and the potential of the company.